Hello everyone, Karl Weiss at Fairway Independent Mortgage with another Mortgage Minute, and today we have a special guest. We have Mr. Seth Fink, who's a CPA, the finest CPA in the state, my opinion, and he's going to share with us the new 2018 tax law changes and how they might impact you if you're considering purchasing a home, or if you're a renter and the idea's been on your mind but you just don't know how to make sense of what the changes are. So thank you so much for joining us today, Seth. So the first question that I have is, with the new tax law changes, to me, the one that stands out the most is how the standard deduction is changing for most taxpayers. So can you kind of take us through what what the change is and what you think that the impacts will be from that change?
Certainly. For each taxpayer filing status, whether it was single, head of household, or married filing jointly, the standard deduction is doubling for 2018. So for someone who filed filed a return with a standard deduction in 16, they're going to find themselves with that amount doubling in 2018, for example, and reducing their tax bill accordingly with less taxable income.
Okay, so doubling, so that's a big deal. So let's take somebody who's never itemized before. Let's talk about that individual, that couple. They've been doing a standard deduction of X in the past. What does that look like for 2018?
Well, with that standard deduction doubling, depending on their tax bracket, if let's say someone was in the marginal tax bracket of 22%, which is one of the brackets for 2018, they're going to see 22% of that additional $12,000 come back in their pocket as actual tax savings.
Wow, that's huge. That number crunches out to be about $19,000 worth of purchase price when we're talking about homes. Now, in our market, we all know currently, as we're recording this in the end of January of 2018, that the inventory in the Phoenix metro area is very low. Homes that are being listed for sale are selling rather quickly, and prices are going up. So this would be a mechanism where you could afford more home without having that price impact your take-home pay. What would a strategy be that we could look at to have people have that extra funds and not have to wait until tax filing to do that?
Typically what we'll do is we'll encourage people to calculate what their taxes would be based on these new tax law changes, and reverse engineer and go backwards to figure out, okay, if I know my tax bill is going to be $3,000 less this year, readjusting their withholding to ensure that they can actually have that money in their paycheck every pay period, versus waiting until the end of the year to get that refund and giving the government that interest-free loan for the year.
Fantastic, right. So we change with our HR department internally at your company, you change your withholding after you've calculated the tax. So every paycheck you get a little bump, like getting a raise, but the raise is really just a result of not giving the IRS an interest-free tax loan during the course of the year and waiting for a refund, but systematically breaking up what would have been a refund potentially over your pay periods over the course of the year. And those funds are the funds that we would then use to help purchase a home and make mortgage payments from.
Correct.
That's phenomenal. I love that idea. That is great.